Question 1. Cost-benefit analysis shows that while a trading halt can disrupt market liquidity and investor access to securities, the potential for widespread investor harm and market manipulation from trading on material, non-public information necessitates swift regulatory action. A registered representative at your firm has just alerted you to credible rumors circulating on a private online forum that a major pharmaceutical company is about to announce disappointing clinical trial results for a key drug. This information, if true, would significantly impact the stock price. As the Series 9 General Securities Sales Supervisor, what is the most appropriate immediate action to take? Option A. Attempt to independently halt trading in the stock through internal firm procedures. Option B. Immediately contact the relevant exchange and FINRA to discuss the potential for a trading halt and report the information. Option C. Wait to see if the stock price moves significantly before taking any action. Option D. Advise the registered representative to instruct clients to sell the stock immediately to avoid losses. The correct answer is B. Immediately contact the relevant exchange and FINRA to discuss the potential for a trading halt and report the information. Explanation. This scenario presents a professionally challenging situation because it requires a supervisor to balance the immediate need for information with the regulatory imperative to halt trading when material, non-public information is being disseminated. Supervisor must act decisively to protect market integrity and investors without prematurely or unnecessarily disrupting trading. Careful judgment is required to assess the nature and impact of the information and to follow the correct procedures. The correct approach involves immediately contacting the exchange or FINRA to discuss the potential for a trading halt once the supervisor becomes aware of the significant, non-public information being circulated. This aligns with the regulatory framework that mandates prompt action to prevent insider trading and market manipulation. FINRA Rule 5320, Prohibition on Trading Ahead of Customer Orders, and related SEC rules emphasize the importance of fair and orderly markets. By initiating contact with the relevant regulatory bodies, the supervisor is fulfilling their supervisory responsibility to ensure compliance and protect investors. This proactive step allows regulators to make an informed decision about a trading halt, thereby upholding market integrity. An incorrect approach would be to wait for confirmation of the information's accuracy before contacting regulators. This delay could allow significant trading to occur based on the non-public information, leading to potential violations of insider trading rules and market manipulation. Another incorrect approach would be to attempt to halt trading independently without consulting the exchange or FINRA. Such an action bypasses the established regulatory procedures and could lead to confusion and disruption. Finally, an incorrect approach would be to ignore the information, assuming it is rumor or insignificant. This failure to act would be a direct dereliction of supervisory duty and a violation of the obligation to maintain fair and orderly markets. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. Upon receiving credible information about potentially market-moving, non-public news, the immediate step should be to consult the relevant regulatory bodies, e.g., FINRA, the exchange, to assess the situation and determine the appropriate course of action, which may include recommending a trading halt. This framework emphasizes a proactive, compliant, and responsible approach to market oversight. Question 2. Investigation of a registered representative's understanding of option pricing requires a supervisor to assess their grasp of the fundamental factors that influence an option's premium. Which of the following best demonstrates the supervisor's evaluation of this conceptual understanding, adhering to FINRA regulatory framework for sales practices and supervision? Option A. The supervisor tests the representative's ability to recall a list of the 5 primary factors that influence option prices from memory. Option B. The supervisor asks the representative to describe the historical price trends of a particular underlying asset over the past year and how those trends might have impacted option premiums. Option C. The supervisor asks the representative to explain in general terms how an increase or decrease in the underlying asset's price, the strike price, time to expiration, implied volatility, and prevailing interest rates would affect the premium of both a call and a put option, without using specific numerical examples. Option D. The supervisor requires the representative to accurately calculate the theoretical value of a specific call option using the Black-Scholes model, given a set of market parameters. Correct answer is C. The supervisor asks the representative to explain, in general terms, how an increase or decrease in the underlying asset's price, the strike price, time to expiration, implied volatility, and prevailing interest rates would affect the premium of both a call and a put option, without using specific numerical examples. Explanation. This scenario is professionally challenging because it requires a supervisor to assess a registered representative's understanding of a fundamental options concept, specifically the factors influencing option prices, in a way that goes beyond mere calculation. The challenge lies in ensuring the representative grasps the qualitative and theoretical underpinnings, which are crucial for providing suitable advice to clients. A supervisor must evaluate the representative's ability to articulate these concepts and apply them to real-world client situations, adhering strictly to FINRA regulations governing sales practices and supervision. The correct approach involves the supervisor evaluating the registered representative's ability to explain how changes in the underlying asset's price, the strike price, time to expiration, implied volatility, and interest rates conceptually affect an options premium, without relying on specific numerical examples. This aligns with FINRA Rule 3110, Supervision, and the general principles of suitability, FINRA Rule 2111. Supervisors are obligated to ensure that associated persons understand the products they recommend and can explain them to customers in a manner that is not misleading. Focusing on the conceptual relationships demonstrates a deeper understanding necessary for client interactions and compliance. An incorrect approach that focuses solely on the representative's ability to calculate an option's theoretical value using a pricing model fails to assess conceptual understanding. This is a regulatory failure because it prioritizes mathematical proficiency over the ability to explain the underlying drivers of price, which is essential for client communication and suitability. Another incorrect approach that emphasizes memorizing a list of factors without explaining their impact on the premium is also deficient. This demonstrates a lack of comprehension and an inability to apply the knowledge, violating the principle of ensuring representatives understand the products they are discussing. Finally, an approach that tests the representative's knowledge of historical option price movements without linking it to the current factors affecting price is insufficient. While historical data can be informative, it does not directly address the forward-looking nature of option pricing and the impact of current market conditions. Professionals should approach this by first identifying the core knowledge required for the product being discussed. In this case, it's the qualitative understanding of option pricing determinants. Supervisors should then design assessments that directly test this conceptual understanding through explanation and application, rather than solely through calculation or rote memorization. This ensures that representatives can effectively communicate risks and benefits to clients, fulfilling their suitability obligations and adhering to supervisory responsibilities. Question 3. The monitoring system demonstrates that a registered representative has received a request from a client to implement a protective put strategy on a significant portion of their equity holdings. The client has expressed a desire to lock in current gains and reduce potential losses without selling the underlying stock. The representative has a general understanding of protective puts, but has not yet engaged in a detailed discussion with the client regarding their overall financial objectives, risk tolerance beyond this specific concern, or their tax situation. Which of the following represents the most appropriate next step for the registered representative? Option A. Proceed with executing the protective put strategy after confirming the client understands the basic mechanics of buying a put option. Option B. Suggest a more complex option strategy that offers potentially higher returns, as the client has demonstrated an interest in managing their equity positions. Option C. Conduct a thorough suitability assessment with the client to understand their complete investment profile, including risk tolerance, financial situation, and tax implications, before recommending or implementing the protective put strategy. Option D. Immediately execute the protective put strategy as requested by the client to fulfill their stated objective of limiting downside risk. The correct answer is D. Immediately execute the protective put strategy as requested by the client to fulfill their stated objective of limiting downside risk. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance the client's stated investment objective with the practical implications and suitability of a complex option strategy. The representative must not only understand the mechanics of a protective put, but also assess its appropriateness for a client with specific risk tolerance and tax considerations, all while adhering to FINRA rules regarding suitability and supervision. The core difficulty lies in ensuring that the recommendation aligns with the client's best interests, not just their stated desire for a particular strategy. The correct approach involves a thorough suitability assessment that goes beyond simply implementing the client's request for a protective put. This entails understanding the client's overall financial situation, investment objectives, risk tolerance, and tax status. A protective put is designed to limit downside risk on an existing stock position. Therefore, the representative must confirm that the client understands the costs associated with the put premium, the limited profit potential on the stock once the put is in place, and how the strategy impacts their overall portfolio risk and tax liability. This aligns with FINRA Rule 2111, Suitability, which mandates that firms and their associated persons have a reasonable basis to believe a recommended investment or strategy is suitable for a particular customer based on their investment profile. It also reflects the ethical obligation to act in the customer's best interest. An incorrect approach would be to immediately execute the protective put strategy solely based on the client's request, without further inquiry. This fails to meet the suitability requirements, as it bypasses the necessary due diligence to confirm the strategy's appropriateness for the client's specific circumstances. It also neglects to consider potential tax implications, such as how the premium paid for the put might affect the cost basis of the stock, or the tax treatment of any gains or losses. Another incorrect approach would be to recommend a more complex or aggressive option strategy that is not aligned with the client's stated objective of protection, or to fail to adequately explain the risks and costs of the protective put, thereby misleading the client. Such actions would violate FINRA rules regarding fair dealing and potentially lead to misrepresentation. The professional decision-making process for similar situations should begin with actively listening to and understanding the client's stated objective. This should be followed by a comprehensive suitability assessment, gathering information about the client's financial situation, investment objectives, risk tolerance, and time horizon. The representative must then evaluate the proposed strategy, in this case, a protective put, against this profile, considering its risk/reward characteristics, costs, and tax implications. If the strategy appears suitable, the representative must clearly and fully explain the strategy, including its benefits, risks, and costs, to the client before execution. If the strategy is not suitable, the representative should explain why and propose alternative strategies that better meet the client's needs. Question 4. Stakeholder feedback indicates that a registered representative has been actively recommending complex option strategies, including straddles and various types of spreads, to a broad range of clients. The representative's rationale often centers on the potential for high returns and the ability to profit from different market movements. However, there is concern that the representative may not be consistently tailoring these recommendations to individual client circumstances, risk appetites, or specific investment objectives. As a supervisor, which of the following actions best addresses this situation in accordance with regulatory requirements? Option A. Issue a memo to all registered representatives reminding them of the general risks associated with option trading and encouraging them to exercise caution. Option B. Allow the representative to continue recommending option strategies as long as they disclose the general risks involved in an options disclosure document provided to the client. Option C. Advise the representative to focus solely on recommending covered calls and protective puts, as these are generally considered less complex and lower risk strategies. Option D. Immediately halt all option strategy recommendations by the representative until a comprehensive review of their client interactions and suitability assessments can be completed, and provide additional training on suitability requirements for complex products. The correct answer is D. Immediately halt all option strategy recommendations by the representative until a comprehensive review of their client interactions and suitability assessments can be completed, and provide additional training on suitability requirements for complex products. Explanation. This scenario presents a professional challenge because a registered representative is recommending complex option strategies to a client without fully understanding the client's objectives and risk tolerance, potentially leading to unsuitable recommendations. The Series 9 exam emphasizes the supervisor's responsibility to ensure that recommendations are suitable for the customer. A supervisor must exercise careful judgment to prevent the firm and its representatives from engaging in practices that could harm investors or violate regulatory standards. The correct approach involves a thorough understanding of the client's financial situation, investment objectives, and risk tolerance before recommending any option strategy. This aligns with FINRA Rule 2111, Suitability, which requires firms and their associated persons to have a reasonable basis to believe that a recommended transaction or investment strategy involving a security or a security-based swap is suitable for a customer based on the customer's investment profile. A covered call strategy, for instance, is suitable for an investor who owns the underlying stock and is willing to forego potential upside appreciation in exchange for premium income, while also accepting the risk of having to sell the stock at the strike price. A protective put is suitable for an investor who owns the underlying stock and wants to hedge against a potential decline in its price. Understanding these nuances in relation to the client's profile is paramount. Recommending a straddle or strangle without a clear understanding of the client's expectation of significant price movement in either direction, and their capacity to absorb potential losses if the price remains stable or moves unfavorably, is a regulatory failure. These strategies are inherently riskier and more complex than covered calls or protective puts. Similarly, recommending various spreads bull call, bull put, bear put, calendar diagonal, without a detailed assessment of the client's market outlook, risk appetite, and capital commitment is also a violation. These strategies involve multiple legs and can have complex risk/reward profiles that must be matched to a client's specific investment profile. Failure to conduct this due diligence constitutes a violation of suitability rules and potentially the general anti-fraud provisions of securities laws, as it can lead to recommendations that are not in the customer's best interest. The professional decision-making process for similar situations should involve a structured approach. 1. Client profile assessment. Always begin with a comprehensive understanding of the client's financial situation, investment objectives, time horizon, and risk tolerance. This is the bedrock of any suitable recommendation. 2. Strategy matching. Carefully match the characteristics of the option strategy, risk, reward, complexity, capital requirements to the client's profile. 3. Disclosure and education. Ensure the client fully understands the risks and potential rewards of any recommended strategy, including the possibility of losing the entire investment. 4. Supervisory oversight. As a supervisor, rigorously review recommendations to ensure they meet suitability standards and that the representative has adequately performed their due diligence. Question 5. When evaluating a registered representative's understanding of basic options terminology, which of the following accurately defines a put option? Option A. The right to buy an underlying security at a specified price on or before a certain date. Option B. The obligation to sell an underlying security at a specified price on or before a certain date. Option C. The right, but not the obligation, to sell an underlying security at a specified price on or before a certain date. Option D. The right to sell an underlying security at its current market price on or before a certain date. The correct answer is C. The right, but not the obligation, to sell an underlying security at a specified price on or before a certain date. Explanation. This scenario is professionally challenging because it requires a supervisor to assess a registered representative's understanding of fundamental options concepts, which is crucial for ensuring client suitability and compliance with FINRA rules. Misunderstanding these basic definitions can lead to inappropriate recommendations and potential regulatory violations. The supervisor must not only identify the correct definition, but also understand why the other options are incorrect from a regulatory and ethical standpoint. The correct approach involves accurately identifying the definition of a put option as the right, but not the obligation, to sell an underlying security at a specified price within a given time frame. This aligns with the core principles of options trading and is fundamental to understanding investment strategies. FINRA Rule 2110, Standards of Commercial Honor and Principles of Fair Dealing, and the suitability requirements under FINRA Rule 2360, Options, mandate that registered representatives have a thorough understanding of the products they recommend. A correct grasp of these definitions ensures that representatives can properly explain the risks and potential rewards to clients, facilitating informed decision-making and preventing misrepresentation. An incorrect approach that defines a put option as the obligation to sell the underlying security at a specified price is fundamentally flawed. This mischaracterizes the nature of an option, conflating it with a futures contract or a binding agreement. Such a misunderstanding could lead to a representative recommending strategies based on incorrect assumptions about the client's potential liability, violating suitability rules, and potentially exposing the client to unintended risks. This also breaches the duty of fair dealing by providing inaccurate information. Another incorrect approach that defines a put option as the right to buy an underlying security at a specified price misidentifies the core function of a put. This definition describes a call option. Recommending a put option based on this incorrect understanding would lead to the opposite of the intended strategy, potentially resulting in significant financial losses for the client and a clear violation of suitability and fair dealing principles. A third incorrect approach that defines a put option solely by its intrinsic value without mentioning the right to sell at a specific price is incomplete and misleading. While intrinsic value is a component of an option's pricing, it does not define the option itself. The defining characteristic of a put is the right to sell at the strike price, regardless of the current market price, and this right is what gives the option its value and purpose. Failing to include this crucial element means the definition is insufficient for proper client explanation and recommendation, thus failing to meet the standards of fair dealing and potentially violating suitability requirements. Professionals should approach such situations by first ensuring their own foundational knowledge is solid. When evaluating a representative's understanding, supervisors should use clear, concise definitions and then probe for conceptual understanding through scenario-based questions. If a representative demonstrates a misunderstanding, the supervisor must provide immediate corrective training and document the interaction, ensuring the representative can accurately explain and recommend products in compliance with all applicable regulations. Question 6. System analysis indicates that a registered representative is discussing a complex option strategy with a client who is seeking to understand the ultimate financial outcomes. The representative recalls the general principles of options profit and loss, but has not specifically calculated or reviewed the maximum profit and loss for this particular strategy in the context of the client's stated investment objectives and risk tolerance. The supervisor is now reviewing this interaction. Which of the following actions by the supervisor best upholds regulatory requirements and ethical obligations regarding maximum profit and loss disclosure for option strategies? Option A. Advise the registered representative to explain to the client that options can offer unlimited profit potential, as this is a key characteristic of options trading. Option B. Direct the registered representative to provide a general explanation of how options profit and loss work, without delving into the specifics of the client's chosen strategy or their financial situation. Option C. Tell the registered representative to focus the discussion on the potential for quick gains, as this is what most clients are interested in when trading options. Option D. Instruct the registered representative to immediately review the specific option strategy's maximum profit and loss potential and discuss it with the client, ensuring it aligns with the client's suitability profile before proceeding. The correct answer is D. Instruct the registered representative to immediately review the specific option strategy's maximum profit and loss potential and discuss it with the client, ensuring it aligns with the client's suitability profile before proceeding. Explanation. This scenario presents a professional challenge because a registered representative is asked to provide guidance on a complex option strategy without fully understanding the client's financial situation or the strategy's risk profile. The core of the challenge lies in the representative's obligation to ensure that any recommended or discussed investment strategy is suitable for the client, and that the client fully comprehends the potential risks and rewards, particularly concerning maximum profit and loss. This requires more than just theoretical knowledge. It demands an ethical application of that knowledge within the regulatory framework. The correct approach involves a thorough suitability assessment and a clear, comprehensive explanation of the maximum profit and loss potential for the specific option strategy being discussed. This aligns with FINRA Rule 2111, suitability, and the general ethical obligation of registered persons to act in the best interest of their customers. A supervisor's role is to ensure that representatives understand these obligations and can effectively communicate them. Explaining the defined risk and reward of a strategy, even if it's a covered call or a vertical spread, is crucial for informed decision-making. The supervisor must ensure the representative can articulate that for certain strategies, profit is capped, and for others, loss is capped, and that the client understands these limits in relation to their investment objectives and risk tolerance. An incorrect approach would be to provide a general overview of options profit and loss, without tailoring it to the client's specific situation or the strategy in question. This fails to meet the suitability standard because it doesn't confirm the strategy's appropriateness for the client. Another incorrect approach is to focus solely on the potential for unlimited profit, ignoring the corresponding potential for significant loss, or vice versa. This misrepresents the risk-reward profile and violates the duty of fair dealing. Providing only a theoretical explanation of maximum profit and loss without relating it to the client's financial capacity or investment goals is also a failure, as it lacks practical application and suitability. The professional decision-making process for similar situations should begin with a clear understanding of the client's investment profile, including their financial situation, investment objectives, and risk tolerance. This information is the foundation for determining suitability. When discussing option strategies, the representative must then clearly articulate the maximum potential profit and maximum potential loss for that specific strategy, ensuring the client understands these limits and how they relate to their overall investment plan. If the representative is unsure about how to explain this or assess suitability, they must seek guidance from their supervisor. The supervisor's role is to ensure that all recommendations and discussions adhere to regulatory requirements and ethical standards, prioritizing client protection and informed consent. Question 7. Analysis of a situation where a client, who has expressed interest in profiting from anticipated significant market volatility, requests the purchase of a long strangle. The client states they understand that this strategy involves buying both a put and a call option with the same expiration date but different strike prices, and that they are prepared for the possibility of losing the entire premium paid. As a Series 9 supervisor, what is the most appropriate course of action to ensure compliance with regulatory requirements and ethical obligations? Option A. Execute the trade immediately to capitalize on the client's expressed interest in volatility, assuming their stated understanding is sufficient. Option B. Advise the client that long strangles are too complex for retail investors and suggest a simpler strategy like buying a single out-of-the-money option. Option C. Conduct a thorough suitability assessment to confirm the client's financial situation, investment objectives, and understanding of the strategy's risk/reward profile and volatility expectations before executing the trade. Option D. Proceed with executing the long strangle, provided the client signs a risk disclosure document acknowledging the potential for total loss of premium. The correct answer is D. Proceed with executing the long strangle, provided the client signs a risk disclosure document acknowledging the potential for total loss of premium. Explanation. This scenario presents a professional challenge because it requires a supervisor to balance a client's stated desire for a potentially aggressive strategy with the firm's obligation to ensure suitability and adherence to regulatory requirements. The supervisor must exercise judgment to determine if the client's understanding and risk tolerance align with the complexities and potential risks of a long strangle, particularly concerning the expectation of significant volatility. The core of the challenge lies in ensuring the client is not only aware of the strategy's mechanics, but also fully comprehends the potential for substantial losses and the specific conditions under which the strategy is most likely to be profitable. The correct approach involves a thorough suitability assessment that goes beyond the client's initial request. This includes a detailed discussion about the client's financial situation, investment objectives, experience with options, and crucially, their understanding of volatility and its impact on long strangle profitability. The supervisor must ensure the client grasps that while a long strangle offers defined maximum risk, it requires a substantial price move in either direction to be profitable, and that time decay works against the position. This aligns with FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a customer, considering the customer's investment profile. Ethically, it upholds the principle of acting in the customer's best interest. An incorrect approach would be to proceed with executing the long strangle solely based on the client's stated interest, without a comprehensive suitability review. This fails to meet the regulatory standard of having a reasonable basis to believe the strategy is suitable. It also represents an ethical failure by not adequately protecting the client from potentially unsuitable risks. Another incorrect approach would be to dismiss the client's interest outright without understanding the underlying rationale or exploring if a modified strategy might be appropriate. This could alienate the client and miss an opportunity to educate them or find a suitable alternative. Finally, recommending the strategy without clearly explaining the significant risk of losing the entire premium paid, especially if volatility does not materialize as expected, would be a failure to provide adequate disclosure, violating both regulatory and ethical obligations. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's request and underlying motivation. 2. Conduct a comprehensive suitability assessment, gathering all necessary information about the client's financial situation, investment objectives, risk tolerance, and experience. 3. Educate the client thoroughly on the proposed strategy, including its mechanics, potential risks, including the risk of total loss of premium, potential rewards, and the specific market conditions required for success. 4. Document all discussions and suitability determinations meticulously. 5. If the strategy remains suitable after thorough assessment and education, proceed with execution. If not, explore alternative strategies that better align with the client's profile or decline to execute the transaction if it cannot be deemed suitable. Question 8. Stakeholder feedback indicates a pattern of increased options trading activity in several customer accounts handled by a particular registered representative. As a Series 9 holder and supervisor, you are reviewing these accounts. Which of the following actions best demonstrates adherence to regulatory requirements for options trading supervision and customer suitability? Option A. Confirming that the registered representative has obtained all necessary customer information, assess the customer's risk tolerance and investment objectives, and ensure that the customer understands the risks and nature of the specific option strategies being employed, along with verifying that all required disclosures have been made. Option B. Accepting the registered representative's verbal assurance that all customers are fully aware of the risks and that all trading is suitable, without conducting independent verification. Option C. Dismissing the activity as too complex for the customers involved without conducting a detailed suitability review or verifying specific disclosures. Option D. Focusing on the sheer volume of options transactions to identify potential issues, assuming that a high number of trades inherently suggests a problem requiring immediate intervention. The correct answer is A. Confirming that the registered representative has obtained all necessary customer information, assessed the customer's risk tolerance and investment objectives, and ensured that the customer understands the risks and nature of the specific option strategies being employed, along with verifying that all required disclosures have been made. Explanation. This scenario is professionally challenging because it requires a supervisor to balance the firm's operational efficiency with the paramount regulatory obligation to ensure customer suitability and appropriate disclosure in options trading. The supervisor must not only understand the intricacies of options, but also the specific rules governing their sale and supervision, as mandated by FINRA for the Series 9 exam. The core challenge lies in identifying and rectifying potential supervisory lapses that could expose both the firm and its customers to undue risk. The correct approach involves a proactive and thorough review of the customer's account activity and the associated supervisory procedures. This entails verifying that the registered representative has adhered to all suitability requirements, including obtaining the necessary customer information, assessing risk tolerance, and ensuring the customer understands the nature and risks of the specific option strategies employed. Crucially, it requires confirming that all required disclosures were made and that the customer's investment objectives align with the trading activity. This aligns directly with FINRA Rule 2111, Suitability, and the supervisory responsibilities outlined in FINRA Rule 3110, supervision. An incorrect approach that focuses solely on the volume of trades, without assessing the suitability or disclosure aspects, fails to meet regulatory standards. This overlooks the fundamental principle that even a high volume of trades can be suitable if they align with a customer's objectives and risk tolerance, and if proper disclosures were made. Conversely, an approach that dismisses the activity as too complex, without a proper suitability review, is also flawed. Complexity itself does not preclude suitability. Rather, it necessitates a more rigorous assessment of the customer's understanding and the representative's diligence. Finally, an approach that relies on the registered representative's assurance of compliance without independent verification is a significant supervisory failure. Supervisors have a duty to establish and maintain a supervisory system reasonably designed to achieve compliance, which includes independent checks and balances, not just reliance on the individual representative's word. The professional decision-making process for similar situations should begin with a clear understanding of the applicable FINRA rules governing options trading and supervision. Supervisors must then systematically review customer accounts and trading activity, looking for red flags that indicate potential suitability or disclosure issues. This review should be documented and should involve direct verification of customer understanding and the representative's adherence to firm policies and regulatory requirements. When deviations are identified, supervisors must take prompt and appropriate corrective action, which may include additional training for the representative, enhanced supervision, or disciplinary measures. Question 9. Stakeholder feedback indicates a need to refine our approach to recommending option strategies to clients. A client who currently holds a diversified portfolio of blue-chip stocks and has expressed a desire to generate additional income from their holdings is considering strategies involving selling options. As a supervisor, how should you guide your registered representatives in assessing the suitability of selling a covered call on a portion of the client's stock holdings? Option A. Instruct representatives to conduct a comprehensive review of the client's investment objectives, risk tolerance, and financial situation to determine if selling covered calls aligns with their overall investment profile and ability to potentially sell their stock at the strike price. Option B. Advise representatives to proceed with recommending the sale of covered calls if the client has expressed a general interest in income generation and owns the underlying stock without further detailed assessment. Option C. Suggest representatives recommend selling naked calls, as this strategy offers higher premium income potential, regardless of the client's existing holdings or risk tolerance. Option D. Guide representatives to recommend buying put options as a primary income-generating strategy, as this provides downside protection for the client's portfolio. The correct answer is B. Advise representatives to proceed with recommending the sale of covered calls if the client has expressed a general interest in income generation and owns the underlying stock, without further detailed assessment. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the suitability of different option strategies for a client based on their stated objectives and risk tolerance, while ensuring compliance with FINRA regulations governing option sales. The supervisor must not only understand the mechanics of buying and selling calls and puts, but also how these strategies align with a client's financial goals and risk profile, preventing unsuitable recommendations. The correct approach involves a thorough review of the client's account information, including their investment objectives, risk tolerance, and financial situation, to determine if selling a covered call is appropriate. This strategy, when executed correctly, can generate income for the client while they hold the underlying stock. Regulatory justification stems from FINRA Rule 2111, Suitability, which mandates that firms and their associated persons must have a reasonable basis to believe a recommended transaction or strategy is suitable for a customer, considering their investment profile. Selling a covered call is a strategy that can be suitable for investors seeking income and who are willing to sell their stock at a specific price. An incorrect approach would be to recommend selling a naked call without a thorough assessment of the client's financial capacity to cover potential losses. This is a highly speculative strategy with unlimited risk potential and would likely violate the suitability rule, as it exposes the client to substantial financial harm without a reasonable basis to believe it aligns with their investment profile. Another incorrect approach would be to recommend buying a put option solely because the client expressed a desire to protect their portfolio, without understanding the cost of the put and the specific downside risk the client is willing to accept. While buying puts can be a hedging strategy, it involves a premium cost that reduces overall returns if the stock price does not fall sufficiently. Recommending this without a clear understanding of the client's risk tolerance for premium loss and their specific hedging needs would be a violation of suitability. Finally, recommending selling a put option to a client who has expressed a strong aversion to taking on additional risk would be inappropriate. Selling a put obligates the client to buy the underlying stock if the option is exercised, which is a risk-taking activity that contradicts their stated preference. This would also be a violation of the suitability rule. The professional decision-making process should involve 1. Actively listening to and documenting the client's stated objectives and risk tolerance. 2. Reviewing the client's existing account information and financial situation. 3. Understanding the risk and reward profile of each proposed option strategy. 4. Matching the strategy to the client's profile, ensuring it meets the suitability requirements. 5. Clearly explaining the strategy, its risks, and potential outcomes to the client. Question 10. Research into a client's investment profile reveals they are an experienced investor with a moderate risk tolerance, seeking capital appreciation, and expressing a belief that the market is poised for significant, unpredictable price swings in a particular underlying stock over the next 60 days. Their registered representative proposes executing a long straddle strategy on this stock, believing it offers a favorable risk/reward profile given the anticipated volatility. As the Series 9 supervisor, what is the most appropriate course of action to ensure suitability and regulatory compliance? Option A. Approve the long straddle recommendation, emphasizing to the representative the importance of educating the client on the potential for significant losses if the stock price does not move substantially in either direction, and to ensure the client can financially absorb such a loss. Option B. Deny the long straddle recommendation, advising the representative to explore less complex strategies that align better with the client's stated moderate risk tolerance and to focus on strategies with more defined risk profiles. Option C. Approve the long straddle recommendation after confirming the client understands the strategy's mechanics and the representative has documented the client's speculative interest and expectation of increased volatility. Option D. Approve the long straddle recommendation, provided the representative can demonstrate a clear, documented analysis of why this specific straddle strategy is the optimal choice for the client's stated objective of capital appreciation and their expectation of increased volatility. The correct answer is C. Approve the long straddle recommendation after confirming the client understands the strategy's mechanics and the representative has documented the client's speculative interest and expectation of increased volatility. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the suitability of a complex option strategy for a client with specific risk tolerance and market outlook, while also ensuring compliance with FINRA regulations. The supervisor must go beyond simply understanding the mechanics of a long straddle and delve into the client's financial situation, investment objectives, and expectations regarding market volatility. The core challenge lies in balancing the client's potential desire for speculative gains with the firm's obligation to recommend suitable investments and supervise registered representatives effectively. The correct approach involves a thorough suitability assessment that prioritizes the client's stated objectives and risk tolerance over the representative's enthusiasm for a particular strategy. This means confirming that the client understands the significant risks associated with a long straddle, particularly the potential for substantial losses if the underlying asset's price movement is insufficient or in the wrong direction. The regulatory justification stems from FINRA Rule 2111, Suitability, which mandates that firms and their associated persons have a reasonable basis to believe a recommended transaction or strategy is suitable for a customer based on their investment profile. This includes considering the customer's financial situation, investment objectives, risk tolerance, and experience. A supervisor's duty is to ensure this assessment is robust and documented. An incorrect approach would be to approve the recommendation solely based on the registered representative's assertion that the client is speculative or wants to make a big move. This fails to meet the reasonable basis requirement of suitability. It ignores the need for a detailed understanding of the client's specific financial capacity to absorb potential losses and the precise nature of their speculative intent. Another incorrect approach is to approve the strategy without verifying that the client has been adequately educated about the risks, including the time decay inherent in options, and the fact that both options in the straddle will expire worthless if the price does not move significantly. This oversight violates the principle of ensuring clients understand the products they are investing in, a key component of suitability and fair dealing. Proving the strategy based on the representative's belief that volatility is coming, without a concrete, documented analysis of the client's profile and the specific rationale for the straddle in relation to that profile, is also a failure. It prioritizes a market prediction over client-specific needs and regulatory obligations. The professional decision-making process for similar situations should involve a structured review. First, confirm the registered representative has conducted a comprehensive suitability analysis, including documented discussions with the client about their financial situation, investment objectives, risk tolerance, and experience with options. Second, evaluate the representative's rationale for recommending the long straddle, ensuring it aligns with the client's profile and expectations for volatility. Third, verify that the client has received and understood all relevant disclosures regarding the risks and potential rewards of the strategy, including time decay and the possibility of losing the entire premium paid. Finally, the supervisor must exercise independent judgment, not simply rubber stamp the representative's recommendation, to ensure compliance with all applicable regulations and ethical standards. Question 11. Operational review demonstrates that a registered representative has proposed a bull-put spread strategy for a client who has expressed a desire for strategies with defined risk and a neutral to slightly bearish market outlook. The supervisor is reviewing the proposal. Which of the following actions by the supervisor best upholds regulatory requirements and professional standards for suitability and supervision of option strategies? Option A. Approving the bull-put spread because it is generally considered a conservative option strategy with limited risk. Option B. Approving the strategy based on the registered representative's assertion that the client is sophisticated in options trading and has traded similar strategies before. Option C. Confirming with the client that they understand the maximum potential profit and loss of the bull-put spread, the strike price is chosen, and the market conditions under which the strategy would be profitable, and verifying that this aligns with their stated objectives and risk tolerance. Option D. Allowing the registered representative to proceed with the strategy as long as the client signs a disclosure document acknowledging the risks of options trading. The correct answer is C. Confirming with the client that they understand the maximum potential profit and loss of the bull-put spread, the strike price is chosen, and the market conditions under which the strategy would be profitable, and verifying that this aligns with their stated objectives and risk tolerance. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the suitability of a complex option strategy for a client, balancing the client's stated objectives with the inherent risks of the strategy. The supervisor must ensure that the client fully understands the bull-put spread, including its limited profit potential, maximum loss, and the market outlook required for success. The challenge lies in moving beyond a superficial understanding of the strategy to a deep dive into its appropriateness for the specific client's financial situation, investment objectives, and risk tolerance, all within the strict confines of FINRA regulations for option supervision. The correct approach involves a thorough review of the client's account, confirming the client's understanding of the bull-put spread's mechanics, risk/reward profile, and the bearish to neutral market outlook it requires. This approach is correct because FINRA Rule 2111, Suitability, mandates that firms and their associated persons must have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a customer, based on the customer's investment profile. For options, this includes a heightened duty to ensure the customer understands the risks involved. A supervisor must verify that the registered representative has adequately assessed the client's financial situation, investment objectives, risk tolerance, and experience with options, and that the bull-put spread aligns with these factors. This aligns with the supervisory responsibilities outlined in FINRA Rule 3110, Supervision, and the specific requirements for options accounts. An incorrect approach would be to approve the strategy solely based on the client's stated interest in a limited risk strategy, without verifying the client's comprehension of the bull-put spread's specific risk/reward characteristics and the necessary market outlook. This fails to meet the suitability standard, as limited risk is a relative term, and the client may not grasp the maximum potential loss or the conditions under which the strategy would be profitable. This also violates the supervisory duty to ensure that registered representatives are not recommending unsuitable investments. Another incorrect approach would be to approve the strategy because the registered representative believes it is a conservative option strategy. This is a subjective judgment that bypasses the objective assessment required by suitability rules. The supervisor must ensure the representative has a reasonable basis for this assessment and that it is grounded in the client's specific profile, not a general categorization of the strategy. This demonstrates a failure in supervisory oversight and a lack of due diligence. A third incorrect approach would be to approve the strategy without confirming the client's understanding of the market outlook necessary for the bull-put spread to be profitable. This strategy profits when the underlying securities price stays above the short-put strike price. If the client expects a strongly bullish market, this strategy would be inappropriate, and the supervisor has a duty to ensure this alignment. Approving it without this confirmation is a failure to ensure the recommendation is suitable for the client's market expectations. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's investment profile thoroughly. Financial situation, investment objectives, risk tolerance and experience. 2. Understand the proposed strategy, its mechanics, profit/loss potential, break-even points, and required market outlook. 3. Assess the alignment. Does the strategy's risk/reward profile and market outlook match the client's profile? 4. Verify client understanding. Ensure the client comprehends the strategy's complexities and risks. 5. Document the process. Maintain records of the suitability assessment and client discussions. 6. Supervise diligently. Ensure registered representatives are adhering to these principles. Question 12. Comparative studies suggest that while covered call writing can be a useful strategy for generating income on existing stock positions, its implementation requires careful consideration of client suitability and risk management. A registered representative proposes to a client who has a moderate risk tolerance and a goal of generating supplemental income that they sell call options against a portion of their existing stock portfolio. The registered representative describes this as a low-risk way to enhance returns. As the Series 9 principle, what is the most appropriate course of action to ensure proper risk management and client protection? Option A. Approve the recommendation immediately, as the client has expressed interest in income generation and the representative has characterized the strategy as low risk. Option B. Instruct the registered representative to sell the call options against the client's entire stock portfolio to maximize the income-generating potential of the strategy. Option C. Review the client's financial profile, investment objectives, and risk tolerance to confirm that the covered call strategy, with its specific risks of capped upside potential and potential for stock depreciation, is suitable for the client and that the representative has adequately explained these risks. Option D. Advise the registered representative to proceed with the strategy, focusing solely on the potential commission income generated by selling the calls, as the client is already a stock owner. The correct answer is C. Review the client's financial profile, investment objectives, and risk tolerance to confirm that the covered call strategy, with its specific risks of capped upside potential and potential for stock depreciation, is suitable for the client and that the representative has adequately explained these risks. Explanation. This scenario presents a common challenge for a Series 9 registered principal, overseeing a registered representative's recommendation of a complex option strategy to a client. The core difficulty lies in ensuring that the recommendation aligns with the client's best interests and risk tolerance, not just the representative's perceived expertise or the potential for commission. A principal's responsibility extends beyond simply approving trades. It involves a proactive assessment of the suitability and risk management of the strategies being employed, particularly when they involve leveraged instruments like options. The correct approach involves a thorough review of the client's financial situation, investment objectives, and risk tolerance, and then evaluating how the proposed covered call strategy fits within those parameters. This includes understanding the specific risks of a covered call, such as the potential for unlimited loss if the underlying stock price falls significantly, though mitigated by owning the stock, and the opportunity cost of capping potential upside gains if the stock price rises sharply above the strike price. The principal must ensure the registered representative has adequately discussed these risks with the client and that the client understands them. This aligns with FINRA Rule 2111, suitability, and the general supervisory obligations under FINRA Rule 3110, which require principals to supervise registered representatives to ensure compliance with securities laws and regulations, including suitability requirements. An incorrect approach would be to approve the recommendation solely based on the registered representative's assertion that it is a conservative strategy or because the client has expressed interest in generating income. This fails to acknowledge that even seemingly conservative option strategies carry specific risks that must be understood and managed in the context of the individual client. It also overlooks the principal's duty to conduct independent due diligence beyond the representative's summary. Another incorrect approach would be to approve the trade without confirming the client's understanding of the potential for cap gains and the risk of the stock price declining below the purchase price, which is a fundamental risk of owning the underlying stock in a covered call. This demonstrates a failure to ensure the client is fully informed about the strategy's implications. Approving the strategy without considering the client's overall portfolio and diversification would also be a failure, as it neglects the holistic view required for sound investment advice. The professional decision-making process for such situations should involve a structured risk assessment. First, the principal must verify that the registered representative has gathered sufficient information about the client's financial profile and objectives. Second, the principal must independently assess the inherent risks of the proposed strategy and how those risks align with the client's profile. Third, the principal must confirm that the registered representative has clearly communicated these risks and potential outcomes to the client and obtain their informed consent. Finally, the principal should document this review process to demonstrate due diligence and compliance. Question 13. The efficiency study reveals that a registered representative is actively engaging with clients to discuss and execute a significant number of options transactions, including both buying and selling various option strategies. The supervisor is tasked with assessing this activity to ensure compliance with regulatory requirements and firm policies. Which of the following approaches best fulfills the supervisor's responsibilities? Option A. Focus primarily on the representative's success in generating commissions from options trades, assuming that profitable trades indicate appropriate client engagement. Option B. Monitor the volume of options trades executed by the representative, intervening only if the number of trades exceeds a predetermined threshold that is not directly linked to client suitability. Option C. Proactively review the representative's client communications and trading activity to identify any patterns that may indicate unsuitable recommendations or violations of options trading rules, focusing on the appropriateness of the strategies for the client's stated objectives and risk profiles. Option D. Wait for customer complaints or significant client losses to arise before investigating the representative's options trading activities. The correct answer is C. Proactively review the representative's client communications and trading activity to identify any patterns that may indicate unsuitable recommendations or violations of options trading rules, focusing on the appropriateness of the strategies for the client's stated objectives and risk profiles. Explanation. This scenario is professionally challenging because it requires a supervisor to balance the firm's obligation to supervise registered representatives with the need to allow for legitimate business development and client service. A supervisor must exercise sound judgment to identify potential compliance issues without stifling productive activity. The core of the challenge lies in distinguishing between proactive client engagement and potentially manipulative or unsuitable sales practices, especially in the complex realm of options trading. The correct approach involves a supervisor proactively reviewing trading activity and communications for patterns that suggest potential suitability issues or rule violations, rather than waiting for a complaint or a significant loss. This approach aligns with FINRA Rule 3110, supervision, and the general principles of sales practice rules, which mandate that firms establish and maintain supervisory systems reasonably designed to achieve compliance with applicable securities laws and regulations. Specifically, supervisors must ensure that recommendations made to customers are suitable for their investment objectives, risk tolerance, and financial situation. By focusing on the asterisk nature asterisk of the recommendations and the asterisk process asterisk of client engagement, the supervisor is fulfilling their duty to prevent misconduct before it occurs. An incorrect approach that focuses solely on the volume of options trades without considering the context of client suitability or the representative's communication is a failure of supervision. This approach neglects the fundamental requirement to assess whether the trades are appropriate for the specific clients involved. Another incorrect approach that involves ignoring any trading activity that doesn't result in a customer complaint abdicates the supervisor's responsibility to be proactive in identifying and addressing potential compliance breaches. This passive stance is a direct violation of supervisory obligations. Finally, an approach that prioritizes the representative's sales performance over compliance concerns is ethically and regulatorily unsound, as it suggests a willingness to overlook potential misconduct for the sake of revenue generation, which is a clear violation of the supervisor's fiduciary duty to the firm and its clients. Professionals should employ a decision-making framework that begins with understanding the firm's supervisory procedures and relevant FINRA rules. They should then analyze trading data and communications with a critical eye, looking for red flags such as high-frequency options, trading in accounts with limited risk tolerance, frequent out-of-the-money option purchases, or a pattern of recommendations that do not align with stated client objectives. When potential issues are identified, the supervisor should engage in further investigation, which may include reviewing client account documentation, discussing the activity with the registered representative, and, if necessary, speaking with the client. This systematic and proactive approach ensures that supervisory duties are met and that client interests are protected. Question 14. Regulatory review indicates that a registered representative can accurately define option Greeks such as delta, gamma, theta, vega, and rho, but struggles to explain how changes in these Greeks would practically impact a client's portfolio value and risk exposure under different market scenarios. As a supervisor, which of the following actions best addresses this situation to ensure compliance with regulatory obligations? Option A. Document the representative's knowledge gap regarding the practical application of Greeks and monitor their client interactions for any immediate suitability issues without further proactive training. Option B. Instruct the representative to focus only on option strategies where the impact of Greeks is less pronounced, thereby minimizing potential client risk. Option C. Provide the representative with additional training focused on applying the practical implications of option Greeks to client portfolio management and risk assessment, followed by a review of their understanding through scenario-based discussions. Option D. Accept the representative's ability to define the Greeks as sufficient, assuming their understanding will develop through experience with client interactions. The correct answer is C. Provide the representative with additional training focused on applying the practical implications of option Greeks to client portfolio management and risk assessment, followed by a review of their understanding through scenario-based discussions. Explanation. This scenario is professionally challenging because it requires a supervisor to assess a registered representative's understanding of complex option concepts beyond mere calculation. Representatives' inability to articulate the practical implications of option Greeks for client portfolios, despite knowing the definitions, highlights a potential gap in their ability to provide suitable recommendations and fulfill their supervisory obligations. A supervisor must ensure that registered persons not only possess theoretical knowledge, but can also apply it to real-world client situations, especially concerning risk management and suitability. The correct approach involves the supervisor recognizing that the representative's understanding is superficial and requires further training. This approach is right because FINRA Rule 3110, Supervision, mandates that firms establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. This includes ensuring that registered representatives understand the products they recommend and can adequately explain the associated risks and potential impacts to clients. The representative's difficulty in explaining the practical impact of Greeks suggests a potential violation of suitability requirements, FINRA Rule 2111, if they were to make recommendations without a deeper comprehension. The supervisor's action to provide targeted training and assess comprehension directly addresses this risk and upholds the firm's supervisory responsibilities. An incorrect approach would be to accept the representative's definitions as sufficient understanding. This fails to acknowledge that understanding Greeks involves more than memorization. It requires the ability to translate these concepts into client-specific risk assessments. This could lead to unsuitable recommendations, violating FINRA Rule 2111, and a failure in supervision under FINRA Rule 3110. Another incorrect approach would be to dismiss the issue as a minor knowledge gap without further action. This neglects the supervisor's duty to ensure competence and compliance within their team. If the representative proceeds to advise clients without a practical grasp of Greeks, it exposes both the representative and the firm to significant regulatory risk and potential client harm. A further incorrect approach would be to focus solely on the representative's ability to perform calculations related to Greeks. While mathematical proficiency is part of understanding, it is not the entirety. The core of the challenge lies in the qualitative interpretation and application of these Greeks to client portfolios and market conditions, which is crucial for suitability and risk management. The professional decision-making process for similar situations should involve 1. Assessing the depth of understanding, not just the breadth of knowledge. 2. Evaluating the practical application of concepts to client scenarios. 3. Identifying potential regulatory risks, e.g., suitability supervision. 4. Implementing targeted training and remedial actions. 5. Verifying comprehension through practical application or scenario-based questioning. Question 15. Consider a scenario where a registered representative proposes executing a bear put spread strategy for a client who has expressed a strong bearish outlook on a particular stock. The client believes the stock is significantly overvalued and likely to decline in the near future. However, the client also has a moderate risk tolerance and has indicated a preference for strategies with defined risk. The supervisor reviewing this proposal must ensure it is suitable. Which of the following approaches best demonstrates adherence to regulatory requirements and professional judgment in this situation? Option A. Advise the client against the bear put spread, suggesting a more conservative strategy, as a bearish outlook alone is not enough to justify a complex option strategy. Option B. Approve the bear put spread execution because the client's bearish outlook directly aligns with the strategy's profit objective, and the strategy inherently has defined risk. Option C. Proceed with the bear put spread without further discussion, assuming the client's stated bearish view and desire for defined risk are sufficient justification for the strategy. Option D. Recommend the bear put spread only after confirming the client fully understands the strategy's limited profit potential and maximum loss, and that this risk/reward profile is acceptable given their moderate risk tolerance and investment objectives. The correct answer is B. Approve the bear put spread execution because the client's bearish outlook directly aligns with the strategy's profit objective, and the strategy inherently has defined risk. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the suitability of a complex option strategy for a client with a specific and potentially conflicting market outlook and risk tolerance. The supervisor must not only understand the mechanics of a bear put spread, but also apply FINRA rules regarding suitability and supervision of complex products. The core challenge lies in ensuring that the chosen strategy aligns with the client's stated objectives and risk profile, rather than simply executing a trade based on the client's directional view. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, and then determining if a bear put spread is appropriate given their stated bearish outlook and their capacity to absorb potential losses. This aligns with FINRA Rule 2111, Suitability, which mandates that a broker-dealer and its associated persons must have a reasonable basis to believe that a recommended transaction or investment strategy is suitable for a particular customer based on the customer's investment profile. A supervisor's duty extends to ensuring that their registered representatives are adhering to this rule, especially with more complex strategies like bear put spreads where the risk/reward profile needs careful explanation. The strategy's limited profit potential and defined maximum loss must be clearly understood and acceptable to the client. An incorrect approach would be to recommend or approve the bear put spread solely because the client expresses a bearish market outlook. This fails to consider the client's overall investment profile, including their risk tolerance and financial capacity. FINRA Rule 2111 requires more than just a directional alignment. It demands a comprehensive understanding of the customer's circumstances. Another incorrect approach would be to proceed with the trade without ensuring the client fully understands the risks and rewards of the bear-put spread, particularly the limited profit potential and the possibility of losing the entire premium paid if the underlying security moves contrary to expectations or not enough. This oversight violates the principle of ensuring customers are adequately informed about the products they are investing in, which is a cornerstone of ethical conduct and regulatory compliance. A third incorrect approach would be to dismiss the client's bearish outlook and suggest a different strategy without a proper suitability assessment, as this ignores the client's stated objectives and could lead to a recommendation that is not aligned with their views. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's profile. Gather and review all relevant information about the client's financial situation, investment objectives, risk tolerance, and investment experience. 2. Analyze the proposed strategy. Fully comprehend the mechanics, risk/reward profile, and market outlook required for the strategy to be profitable. For a bear-put spread, this means understanding that it profits from a decline in the underlying asset's price, has a limited profit potential, and a defined maximum loss. 3. Match strategy to profile. Determine if the strategy's characteristics align with the client's profile. Does the client's risk tolerance accommodate the potential loss? Are their objectives met by the strategy's profit potential? 4. Educate the client. Ensure the client fully understands the strategy, including its potential gains, losses, and the conditions under which each might occur. 5. Document the recommendation. Maintain thorough records of the suitability assessment and the client's understanding. Question 16. The audit findings indicate a pattern of inconsistent application of order entry procedures by registered representatives, specifically concerning the documentation and verification of client instructions for various order types, including market, limit, and stop-loss orders. Which of the following actions by the General Securities Sales Supervisor best addresses these findings in accordance with regulatory expectations? Option A. Instruct registered representatives to rely on their best judgment for order entry documentation, emphasizing that the primary goal is to meet client needs without excessive administrative burden. Option B. Advise registered representatives that, while consistency is preferred, minor variations in order entry documentation are acceptable as long as the trades are executed efficiently. Option C. Focus on the overall volume of trades processed by the registered representatives, assuming that high volume indicates adherence to procedures and client satisfaction. Option D. Conduct a comprehensive review of the firm's written supervisory procedures for order entry. Compare the observed practices against these procedures and relevant FINRA rules, and implement targeted training for registered representatives on proper order entry and documentation. The correct answer is D. Conduct a comprehensive review of the firm's written supervisory procedures for order entry. Compare the observed practices against these procedures and relevant FINRA rules, and implement targeted training for registered representatives on proper order entry and documentation. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the appropriateness of order entry procedures in a real-time or near-real-time environment, balancing efficiency with regulatory compliance and client protection. The supervisor must not only understand the technical aspects of different order types, but also their implications for risk management and adherence to FINRA rules governing order handling and supervision. The core challenge lies in identifying deviations from established procedures and determining the severity of these deviations, which could range from minor administrative oversights to potentially manipulative practices or breaches of fiduciary duty. The correct approach involves a thorough review of the firm's written supervisory procedures, WSB, concerning order entry, and a comparison of the observed practices against these WSBs and relevant FINRA rules. This approach is correct because it directly addresses the audit's concern by evaluating adherence to established internal controls and external regulations. FINRA Rule 3110, Supervision, mandates that firms establish and maintain WSBs reasonably designed to achieve compliance with applicable securities laws and regulations. Furthermore, rules related to order handling, such as those concerning best execution and the fair and orderly execution of transactions, are implicitly tested when examining order entry procedures. A supervisor's duty is to ensure that all registered persons are following these procedures, and that the procedures themselves are adequate. An incorrect approach would be to dismiss the findings as minor operational issues without further investigation. This is incorrect because it fails to acknowledge the potential for systemic problems or individual misconduct that could lead to client harm or regulatory violations. Ignoring such findings could be seen as a failure to supervise, violating FINRA Rule 3110, and could expose the firm and its associated persons to disciplinary action. Another incorrect approach would be to focus solely on the volume of trades executed without considering the specific types of orders and the procedures followed for each. This is incorrect because the risk and regulatory implications vary significantly between different order types. For example, a market order has different execution characteristics and potential risks than a limit order or a stop-loss order. A supervisor must understand these nuances to properly assess compliance. A third incorrect approach would be to assume that all registered representatives are acting in good faith and that any deviations are unintentional errors. While good faith may be a factor in determining intent, it does not absolve the firm or the supervisor of the responsibility to ensure that procedures are followed and that the firm's systems and controls are robust. This approach neglects the supervisory obligation to proactively identify and correct potential compliance issues. The professional decision-making process for similar situations should involve a systematic review of audit findings, a deep understanding of the firm's WSBs and relevant FINRA rules, and a proactive approach to investigation and remediation. Supervisors should prioritize issues based on their potential impact on clients and the firm's regulatory standing. When deviations are identified, the process should include gathering all relevant information, interviewing involved parties, assessing the root cause of the deviation, and implementing corrective actions, which may include additional training, policy revisions, or disciplinary measures, all while documenting the entire process. Question 17. The investigation demonstrates that a registered representative is considering recommending the writing of covered calls on a client's existing stock portfolio. The client has explicitly stated a conservative risk tolerance and a primary objective of capital preservation, with a secondary goal of generating modest income. The representative believes the covered call strategy could enhance the client's income stream. Which of the following approaches best aligns with regulatory requirements and professional judgment in this scenario? Option A. Decline to recommend covered call writing, explaining that the strategy's capped upside potential and inherent risks of stock ownership may not align with the client's conservative capital preservation objective, and explore alternative income-generating strategies that better fit the client's profile. Option B. Proceed with recommending covered call writing, assuming that any client with a stock portfolio is open to strategies that can generate additional income, regardless of stated objectives. Option C. Recommend covered call writing, emphasizing the income generation potential, and proceed if the client agrees to the premium received. Option D. Recommend covered call writing, focusing on the premium income, and advise the client that it is a low-risk strategy for generating income. The correct answer is C. Recommend covered call writing, emphasizing the income generation potential, and proceed if the client agrees to the premium received. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance a client's stated investment objective with the inherent risks and suitability requirements of a covered call writing strategy. The representative must not only understand the mechanics of the strategy, but also its implications for a client with a conservative risk tolerance and a desire for capital preservation. The challenge lies in ensuring that the recommendation aligns with regulatory obligations, specifically the duty of suitability, which mandates that recommendations be appropriate for the customer's investment profile. The correct approach involves a thorough suitability assessment that prioritizes the client's stated objectives and risk tolerance. This means recognizing that while covered call writing can generate income, it also caps potential upside appreciation and exposes the client to the risk of the underlying stock declining in value. Therefore, recommending this strategy without a clear understanding of how it fits the client's conservative profile and capital preservation goal would be a violation of suitability rules. The representative must explain the trade-offs, including the limited profit potential and the risk of loss if the stock price falls significantly, and ensure the client fully comprehends these aspects before proceeding. This aligns with FINRA Rule 2111, which requires firms and their associated persons to have a reasonable basis to believe, at the time a recommendation is made, that the transaction or strategy is suitable for the customer based on the customer's investment profile. An incorrect approach would be to recommend covered call writing solely based on the potential for enhanced income, without adequately addressing the client's conservative risk tolerance and capital preservation objective. This fails to meet the suitability standard because it prioritizes a potential benefit, income, over the client's primary stated goals and risk aversion. Such an action could lead to a recommendation that is not in the client's best interest, potentially exposing them to undue risk or limiting their ability to achieve their financial objectives. Another incorrect approach would be to proceed with covered call writing without a detailed discussion of the strategy's risks and limitations, particularly the capped upside potential and the risk of loss if the underlying stock declines. This oversight constitutes a failure to provide the client with the necessary information to make an informed decision, which is a cornerstone of ethical conduct and regulatory compliance. The client must understand that, while they receive a premium, they forego further gains if the stock price rises significantly above the strike price, and they still bear the risk of the stock's depreciation. A third incorrect approach would be to recommend covered call writing without considering the tax implications for the client. While not the primary focus of suitability, understanding how the premiums received and any potential capital gains or losses are taxed is part of providing comprehensive advice. Failing to consider this aspect, especially for a client focused on capital preservation, could lead to unexpected tax liabilities that detract from their overall financial well-being. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's investment profile, including their financial situation, investment objectives, risk tolerance, and time horizon. This understanding forms the basis for evaluating any proposed investment strategy. The representative must then critically assess whether the strategy's risk/reward profile aligns with the client's profile. If a strategy like covered call writing is considered, the representative must be able to articulate its benefits and drawbacks clearly, ensuring the client comprehends the potential for both gains and losses, as well as any limitations. Transparency and thorough client education are paramount to fulfilling the duty of suitability and maintaining ethical standards. Question 18. The analysis reveals that a client expresses a moderately bullish outlook on a particular stock, anticipating a modest price increase over the next few months. The client is seeking a strategy that offers defined risk and is comfortable with a capped profit potential, as they are not expecting a dramatic surge in the stock's price. Considering these factors and the regulatory framework for option sales, which of the following approaches best aligns with suitability requirements for recommending a bull call spread? Option A. Recommend a bull call spread to the client, suggesting it is a suitable strategy regardless of their specific market outlook, as it is a common option strategy. Option B. Recommend a bull call spread, explaining that it allows for participation in a rising market with a known maximum loss, and that profit is capped at the difference between the strike prices minus the net debit paid. Option C. Recommend a bull call spread to the client, focusing solely on the potential for leverage and downplaying the capped profit and defined risk aspects. Option D. Recommend a bull call spread to the client, emphasizing the unlimited profit potential if the stock price rises significantly. Correct answer is B. Recommend a bull call spread, explaining that it allows for participation in a rising market with a known maximum loss, and that profit is capped at the difference between the strike prices minus the net debit paid. Explanation. This scenario presents a professional challenge for a Series 9 registered person because it requires them to assess the suitability of a complex option strategy, the bull call spread, for a client with a specific, moderately bullish outlook. The challenge lies in ensuring the client fully understands the strategy's risk and reward profile, its alignment with their market view, and the potential for limited profit and substantial loss, all within the stringent regulatory framework governing option sales. A supervisor must not only understand the strategy, but also the client's financial situation, investment objectives, and risk tolerance to make a recommendation or approve a transaction. Correct approach involves recommending a bull call spread only when the client expresses a moderately bullish outlook and understands that the strategy offers defined risk and defined, limited profit potential. This aligns with the regulatory requirement to recommend only suitable investments. The justification is rooted in FINRA Rule 2111, suitability, which mandates that firms and their associated persons have a reasonable basis to believe, at the time of making a recommendation, that the transaction or strategy is suitable for the customer based on the customer's investment profile. A bull call spread, with its defined risk, is often suitable for investors who have a moderately bullish view and are seeking a leveraged position with a cap on potential losses, provided they comprehend the limited profit ceiling. An incorrect approach would be to recommend a bull call spread to a client who is extremely bullish and expects significant price appreciation. This is incorrect because a bull call spread caps the profit potential, meaning the client would miss out on further gains if the underlying securities price rises substantially beyond the strike price of the long call. This violates the suitability rule by not aligning the strategy with the client's full market expectation and potentially leading to a suboptimal outcome for the client. Another incorrect approach is to recommend a bull call spread to a client who is uncertain about the market direction or has a neutral to bearish outlook. This is fundamentally unsuitable, as the strategy is predicated on a rising price for the underlying security. Recommending it in such a scenario would be a clear violation of the suitability rule, as the strategy's profit mechanism is directly opposed to the client's likely market view. Finally, recommending a bull call spread without adequately explaining the defined risk and defined profit, or the potential for the entire premium paid to be lost if the underlying price does not move favorably, is also an ethical and regulatory failure. This failure stems from not fulfilling the obligation to ensure the customer understands the nature and risks of the recommended product, as required by FINRA Rule 2360 options. The professional decision-making process for similar situation should involve a thorough client discovery process to ascertain their market outlook, risk tolerance, financial situation, and investment objectives. Once this profile is established, the registered person must then evaluate various investment strategies, including option strategies like the bull call spread, to determine which best fits the client's profile. Crucially, any recommendation must be accompanied by a clear and comprehensive explanation of the strategy's mechanics, profit and loss potential, and associated risks, ensuring the client can make an informed decision. Question 19. Risk assessment procedures indicate that a registered representative has recommended a calendar spread strategy to a client. As the Series 9 supervisor, which of the following actions best ensures compliance with suitability requirements and the client's understanding of the strategy's implications? Option A. Confirm with the registered representative that the client has prior experience trading options and approve the trade, assuming sophistication implies suitability. Option B. Approve the trade immediately upon receiving the recommendation, as calendar spreads are generally considered to have defined risk, making them suitable for most clients. Option C. Request a detailed mathematical projection of the maximum potential profit and loss from the registered representative, and approve the trade if the potential profit exceeds the potential loss by a significant margin. Option D. Review the client's account statements to verify their overall asset allocation, and then discuss with the registered representative how the calendar spread fits within that allocation and the client's stated investment objectives, ensuring the client understands the impact of time decay on both legs of the spread. The correct answer is A. Confirm with the registered representative that the client has prior experience trading options and approve the trade, assuming sophistication implies suitability. Explanation. This scenario is professionally challenging because it requires a supervisor to assess the suitability of a complex option strategy, a calendar spread, for a client whose financial situation and investment objectives are not fully detailed. The supervisor must ensure that the client understands the strategy's nuances, particularly its risk profile and the impact of time decay, and that it aligns with their stated goals. This necessitates a thorough review of the client's profile and a clear explanation of the strategy's mechanics, rather than a superficial approval. The correct approach involves the supervisor proactively engaging with the registered representative to understand the client's specific circumstances and the rationale for recommending the calendar spread. This includes verifying that the client has been fully informed about the potential for limited profit and substantial loss, the impact of time decay on both legs of the spread, and that the strategy is consistent with their risk tolerance and investment objectives. This aligns with FINRA Rule 2111, suitability, and the general supervisory obligations under FINRA Rule 3010, which mandate that firms and their associated persons have a reasonable basis to believe that a recommended transaction or strategy is suitable for a particular customer. A supervisor's duty is to ensure that recommendations are not only technically sound, but also ethically appropriate and compliant with regulatory requirements. An incorrect approach would be to approve the trade solely based on the registered representative's assertion that the client is sophisticated or has prior options trading experience. This fails to meet the supervisor's obligation to conduct an independent assessment of suitability. It bypasses the crucial step of verifying the client's current financial situation, investment objectives, and risk tolerance against the specific characteristics of the calendar spread, which can involve significant risk if market movements are not as anticipated or if time decay erodes potential gains. This approach risks violating suitability rules by relying on assumptions rather than verified information. Another incorrect approach is to approve the trade without ensuring the client understands the time decay implications of a calendar spread. Calendar spreads involve selling one option and buying another with a different expiration date. The value of these options is significantly affected by time decay, especially as the short-term option approaches expiration. If the supervisor does not confirm that the client grasps how time decay can impact the profitability and risk of the spread, particularly the potential for the short option to expire worthless, while the long option still retains value, or vice versa, it constitutes a failure in ensuring the client's comprehension of the strategy. This oversight can lead to unsuitable recommendations and potential client dissatisfaction or financial harm, violating the spirit and letter of suitability and fair dealing requirements. A third incorrect approach is to approve the trade without considering the client's overall investment portfolio and financial goals. A calendar spread, while potentially offering defined risk and reward, is still a speculative strategy. If the client's portfolio is heavily weighted towards conservative investments, or if their financial goals are short-term and require capital preservation, a calendar spread might be inappropriate, regardless of the client's perceived sophistication. The supervisor must ensure that the strategy fits within the client's broader financial picture, not just as an isolated transaction. This holistic review is fundamental to fulfilling suitability obligations. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's profile. Thoroughly review the client's financial situation, investment objectives, risk tolerance, and investment experience. 2. Analyze the strategy. Deeply understand the mechanics, risks, potential rewards, and time decay characteristics of the proposed option strategy, in this case a calendar spread. 3. Assess alignment. Determine if the strategy's risk/reward profile and time horizon align with the client's profile and objectives. 4. Verify client understanding. Ensure the registered representative has adequately explained the strategy, including its risks and potential outcomes, to the client. 5. Document the recommendation. Maintain clear records of the suitability assessment and the client's understanding. 6. Supervisory review. As a supervisor, conduct an independent review to confirm the suitability and compliance of the recommendation. If any aspect is unclear or potentially unsuitable, further investigation or discussion with the registered representative, and potentially the client, is required before approval. Question 20. To address the challenge of recommending an option strategy to a client who believes a particular stock is poised for a significant upward move, what is the most appropriate initial course of action for a registered representative? Option A. Suggest the client purchase a large quantity of the underlying stock, as this is a more straightforward way to profit from an anticipated price increase. Option B. Proceed with recommending a bull call spread after confirming the client's belief in the stock's upward trajectory and explaining the strategy's mechanics. Option C. Immediately recommend a bull call spread, explaining that it offers leveraged participation in the stock's potential rise while limiting the maximum loss to the net premium paid. Option D. Conduct a thorough suitability assessment to understand the client's financial situation, investment objectives, and risk tolerance before determining if a bull call spread or any option strategy is appropriate. Correct answer is C. Immediately recommend a bull call spread, explaining that it offers leveraged participation in the stock's potential rise while limiting the maximum loss to the net premium paid. Explanation. This scenario presents a professional challenge because a registered representative is recommending a complex option strategy to a client without fully understanding the client's investment objectives, risk tolerance, and financial situation. Series 9 exam emphasizes the supervisor's responsibility to ensure that recommendations are suitable for the client and that representatives understand the products they are recommending. A supervisor must also ensure that the representative has conducted adequate due diligence. The correct approach involves the registered representative first conducting a thorough suitability assessment of the client. This includes understanding the client's financial situation, investment objectives, and risk tolerance. Only after this assessment can the representative determine if a specific option strategy, such as a bull call spread, is appropriate. If it is deemed appropriate, the representative must then explain the strategy's risks and potential rewards to the client in clear, understandable terms, ensuring the client comprehends the potential for loss. This aligns with FINRA Rule 2111, suitability, and the general ethical obligation to act in the client's best interest. An incorrect approach would be to recommend the bull call spread solely based on the representative's belief that the stock is likely to rise. This fails to consider the client's individual circumstances and could lead to an unsuitable recommendation, violating FINRA Rule 2111. Another incorrect approach would be to recommend the bull call spread without fully explaining its mechanics, including the limited profit potential and the risk of losing the entire premium paid. This lack of transparency and education can lead to client misunderstanding and dissatisfaction, and potentially violate rules regarding fair dealing and disclosure. A third incorrect approach would be to recommend the bull call spread without considering alternative, potentially less risky strategies that might achieve similar objectives for the client. This demonstrates a lack of comprehensive analysis and a failure to explore all suitable options for the client. The professional decision-making process for similar situations should involve a structured approach. 1. Initiate a comprehensive suitability assessment for every client before recommending any investment, especially complex products like options. 2. Thoroughly understand the client's financial profile, investment goals, and risk appetite. 3. Educate yourself on the intricacies of any recommended product or strategy, including its risks, rewards, and potential outcomes. 4. Clearly and concisely communicate the nature of the investment, its risks, and potential benefits to the client, ensuring their comprehension. 5. Document all client interactions, suitability assessments, and recommendations. 6. If unsure about suitability or the client's understanding, seek guidance from a supervisor or compliance department.